Hola, buenos días. Hoy tenemos con nosotros a Yoann Ignatiew, gestor de R-co Valor desde hace 18 años. Now I switch into English. The first question is, in this environment, how a multi-strat add value?
Multi-strat is not necessarily owning all the strategy. For example, Valor, we own equity and cash. No bond exposure, no credit exposure, because we think that the liquidity versus the reward you have is not enough, specifically for big funds of 10 billions right now. Also, flexibility means that we know our stocks. We are limited numbers of investment, between 45 and 50 lines, basically. But inside that, we are not sitting on our shares waiting for Godot. We are really basically working on the relative value of this company historically and also on the sector allocation to see if we need to reinforce or, on the contrary, decrease the positioning, even if we keep quite long-term our investment. Average period of the detention is 7 years. But during that period, we can decrease sometimes by 2/3 of our position, or increasing sometimes 2/3 of our position, because we are very disciplined also in the valuation. So we are very active basically in the way we are managing the funds, and it's give flexibility.
Mm-hmm. How is the portfolio currently structured?
Actually, when you look at the positioning of the portfolio, it's linked to our long-term view approach. What does it mean? It means that it's a dynamic allocation. What does it mean, dynamic? If you look at the allocation of the last 17 years, 18 years, it has been between 50% equity and 99% equity. Right now, we are 72. 72 is pretty much a lower level of investment for equity. Large cap stocks, because it's liquidity. And for the balance, which is a 28%, we only own money market, T-bills, very liquid, who allow us to be very reactive when there is a drawdown that we think it's a good moment to reinforce our equity allocation. So this is where we're managing also sort of flexibility.
When do you add to equities and when you reduce the exposure?
This is at different level. First of all, it's a global environment of rates. Is it challenging for equity or not? The level of also investment in the market is a lot of people are investing in equity, and of course the valuation. So that's where in this kind of situation we decrease globally the allocation of the portfolio. But of course, it's not necessarily the same for one sector to another one. So it can counterbalance a little bit this allocation rate. On the other side, where there is some, like last year, events, very volatile, where you see that the market is de-risking, it creates opportunities. And we are a little bit like searching opportunities like that. When you have good stocks that you used to have, or new stocks that you want, and decreasing by 30, 40, 50% like last year, it creates opportunities. And we really look at these kind of opportunities if we think that the risk reward for the sectors or for the company is really interesting. This is the way we are developing more investment in the portfolio.
From a macro perspective, what are your main scenarios today?
Macro perspective is good globally for the growth in the world. We will probably reach something like 3%. But macro is one thing. The market is another thing. The market knows that. So the valuation of some assets, specifically in US, are challenging. And for foreigner investors, on top of that, need to invest in US dollars, it's even more challenging. So 26 in an environment where there is election, of course, in the US, also in Brazil, where we have some positioning. And of course, it can create also some volatility around this election. We think that 26 will be a volatile year. So what does it mean for us? Volatility is obviously creating opportunity. As long as you have the time and the passion to look at building slowly but surely your positioning, and this is what we are trying to do.
What are the key themes currently shaping the portfolio?
The key themes, and we would get global sector allocation. We still own some tech stocks in China, in emerging markets, but also a little bit in US. Not so much a Magnificent Seven. The only one we have is Alphabet, which is our main positioning, and a little bit of Meta. The second allocation, which is probably more original, is the mining sectors. We have the knowledge because we're running a gold mining funds. We're going a strategic metal mining funds. And these two funds give us feeds and knowledge on the company. And this is why we're really bullish on raw materials. Not all the raw materials, but some of them, precisely copper. Copper is, for us, the future oil of the 21st century. You need copper for all kind of infrastructure, for electrification of infrastructure, from database to EV cars, from optic fiber to alien windfall production. You need copper everywhere. And you have a lack of production because of lack of investment. Gold also is something that we put in the portfolio in 2016, not now. Gold is probably a little bit more mature. More people are investing in gold through ETF. And this is new since 2025. That's why we begin to take a little bit of profit on our big gold producer. But in the same time, because also of lack of production, we know that this big gold producer, we need to reinvest to find new production, because if they are not doing that, if they're only financial oriented, meaning that they will buy back equity and give dividend, in 10 years' time, the industry will not produce almost anything in gold. So they will need to produce, and this is why we're also looking at some companies who has really nice project, and recently we invest in a project in gold. So it's really now the second stage of the gold rally. Where is the money can come from in the next 3 or 4 years?
Okay, that's it. Thank you.
Thank you.